So if the question is silent about the final payment of the retiring partner, then it is assumed that his balance is transferred to his loan account, and the journal entry is for that is retiring partner's capital account debited to retiring partner's loan account. And if his loan is carrying the interest, if they have agreed some rate, then that rate will be followed. If nothing is mentioned about the rate, then the 6% per annum as per the Partnership Act will be followed. Now I'm taking one illustration, practical, which is full-fledged practical. It covers almost all the concept we have discussed yet, and retire at the stage of retirement. So this length of question could be of 6 or 8 marks as per the requirement of the question. In this question, it is comprehensive one because it asks not only the journal entry but also asks to prepare all the necessary ledgers, that is revaluation account, partners capital account, apart from this balance sheet of the new firm after the retirement. So ABC were partners sharing profits and losses in the ratio of 5:3:2. So the old ratio between the partners ABC is 5:3:2. Their balance sheet as at 1st April 2018 was as follows. C retires on above date, and partners agreed that first, goodwill is to be valued at 2 years purchase of the average profit of last 4 years. Profit for the years ending 31st March were 2004, 15, 16, 17 and 18 are given. In 2017 there was loss. So goodwill is going to be calculated on the basis of number of years of purchase of average profit. The number of year purchase is given 2. So first of all we will calculate the average profit, and the average profit calculation shown here. So they have calculated the average profit. 4 years profit is given, including 2017 there was a loss that will be deducted. So the total sum total of the 4 years profit is 40,000. So average profit is 40,000 divided by 4. This is 10,000 is the average profit, and the value of goodwill will be average profit multiplied by number of years of purchase, that is 2 is given. So this is the value of goodwill. Goodwill is 20,000. Now retiring partner, C is a retiring partner and his share is 2 by 10. So 2 by 10 of the 20 is 2 by 10 of the 20 is 10. So 4,000 will be the share of goodwill, and this 4,000, because in this question they haven't decided their new profit, remaining partners that is A and B haven't, in the question no information has been given about their new profit sharing ratio. In this case the rule is, if question is silent about the new profit sharing ratio, then the remaining partners will share their profits in their old ratio. So that is, new profit sharing ratio will be 5:3. And because nothing is mentioned about that how they have acquired the share of C, so the gaining ratio is also 5:3. So the share of goodwill credited to the retiring partner, that is C, will be adjusted by passing a journal entry, that is A's capital account to A's capital account, B's capital account debited to C's capital account, and this is 5 is to 3. So 4,000 will be distributed among them, shared by A and B in the ratio of 5 is to 3, that is 2,500 and 1,500. Right. Now, one by one, we will take the 5% adjustment is 5%. 5% provision for doubtful debt is to be made on debtors. Stock be appreciated by 10%. Patents are valueless. Building be appreciated by 20%. Sundry creditor to be paid 2,000 more than the book value. Nothing is mentioned about the final payment to C. So the rule is, when question is silent about the payment, final settlement of the retiring partner, then it is assumed that his claim is transferred to his loan account. Now, first of all, sundry creditors. In liability side, sundry creditor is given. So sundry creditor is 10,000. There is a adjustment. Sundry creditor is to be paid 2,000 more than the book value. So sundry creditor as a liability, it is increasing. So increase in liability is a loss for the business. So the journal entry will be revaluation account debited to sundry creditor account, that is 2,000. They have passed the compound entry, but right now I'm talking about the sundry creditors. So, and this increase of 2,000 will be shown in the balance sheet. In the balance sheet, they have shown, earlier it was 10,000, right now it is 12,000, and in the revaluation account they have shown two sundry creditors 2,000. That is the increase. Now, next item given on the liability side is employees provident fund. There is no adjustment related to employees provident fund, so it should be shown in the balance sheet as it is, that is employees provident fund 5,000. Now, next item in the balance sheet is reserve fund. This reserve fund is given 6,000, and this 6,000 will be as per the rule, reserves should be written off among all the partners in their old ratio. So all the partners, that is A, B, C, in the old ratio 5 is to 3 is to 2. So the journal entry is reserve fund account debited with 6,000. A's to A's capital to B's capital to C's capital 3,000, 18,000 and 12,000. 5 is to 3 is to 2. One I can show you for A, it is A's share is 5 by 10. So 6 5 6 the 30, that is 3,000, right? So rest of is also be correct, and this will be transferred. This is a journal entry. It will be shown in the partners capital account. So partners capital account on the credit side, because it was credited, partners capital account was credited, so we will write by reserve fund this amount individually in their respective column. Now, next is in the question is workmen compensation reserve 2,000. There is no actual liability towards workmen compensation. So this specific reserve will be written off among all the partners in their old ratio, and the journal entry will be workmen compensation reserve account debited to A's capital to B's capital to C's capital, that is in their old ratio 5 is to 3 is to 2. So this will be shown on the credit side of the partners capital account, that is by workmen compensation reserve 1,600 and 400. Now, next item given in the liability side is partners capital balances. So that will be brought down on the credit side of the partners capital account by balance BD, right? So next is in the question is cash. There is no adjustment related to cash, so cash will be shown as it is on the asset side of the balance sheet 2,000, right? Now, next in the item on the asset side is sundry debtors. There is a 5% provision for doubtful debt is to be made on debtor. So debtor balance is given 8,000. 5% of the 8,000 is 400. So creating provision is a liability for the business. So increase in liability should be debited. This is a loss for the business. So journal entry will be revaluation account debited to provision for doubtful debt, that is 400. So this will be transferred to revaluation account on the debit side to provision for doubtful debt because revaluation account was debited, and in the balance sheet we will deduct from the debtor. Second adjustment, debtor is having 8,000 less provision for doubtful debt 400, and the balance amount 6,000 7,600 will be shown in the main column. Right, now next item given in the question is the question is stock. So stock, there is, it is appreciated by 10%. Right now stock is having 40,000. So 10% of the 40,000 is 4,000. So stock is increase. Increase in asset is a profit for the business. It's a gain for the business. So journal entry will be stock account debited to revaluation account with 4,000. Right, this 4,000 is included in this 60,000. Now on the revaluation account credit side, you will write the stock, buy stock 4,000, and in the balance sheet you will add the 4,000. Now it become 44,000. Right, now next item given in the balance sheet, that is furniture. There is no adjustment related to furniture, so this furniture balance should be carried forward as it is in the balance sheet. So in the balance sheet furniture is as it is, they have mentioned 13,000. Now next item in the balance sheet is building. Patents, they are saying patents are valueless means patents lost their values, it becomes zero. So decrease in value of asset is a loss for the business. So the journal entry will be revaluation account debited to patents. 4,000. This 4,000 is included in 6,400. So that should be posted in the ledger revaluation account debit side to patents, and in the balance sheet it will not be shown because it becomes zero. So nothing will be shown in the balance sheet. Next item given in the balance sheet is building. Building is appreciated by 20%. Right now building is having 60,000 balance. So 20% of the 60,000 is 12,000. So increase in value of asset is a gain for the business. So building account debited to revaluation account, this 12,000 is added with the 16,000. So in the balance sheet, first of all we will post into the ledger, that is revaluation account on the credit side, by building 12,000, and in the balance sheet building 12,000 we will add 60,000 plus 12,000, 72,000. Right, so this is all about the apart from this, one more thing is left. This is goodwill is left. So goodwill, this is a existing goodwill. Accounting treatment is existing goodwill should be written off among all the partners in their old ratio. So the journal entry will be A's capital account, B's capital account, C's capital account debited to goodwill. Goodwill is having 6,000 balance, 6,000, and they should share, their capital should be debited in the ratio of 5:3:2. Now no adjustment left. Now for the goodwill we have passed this journal entry. A's capital account debited, B's capital account debited to C's capital account. So in partners capital account A and B should be debited, and in the A and B will be debited. So and again against them the name of the account is C. So 2 C's capital 2,500 and 1,500. C's capital has been credited and against the C's capital there are two accounts which are debited, that will be mentioned here: by A's capital, by A's capital, by B's capital, 2500 and 1500. This is goodwill treatment. Now we will calculate the balances. So A side balance is 58,800, and debit side balance is only 5,500. So we will deduct, this comes A's balance. Apart from this, in at the time of retirement stage, first of all we will calculate the retiring partner's balance. So retiring is C's credit side total is 32,520, and on the credit side only, on the debit side there is only one item, that is 1200. So we will deduct this 1200 from this amount, total amount of the credit 32,520. So 31,300, because final payment has not been made to him, his amount will be transferred to loan account. So we will write to C's loan account 31,320, and the journal entry will be C's capital account debited to C's loan account. This is the total claim was transferred to retiring partner's loan account, and this C's loan account will be shown on the liability side, C's loan 31,320, and rest of remaining partners will be balanced. Their balances are 53,300, 36,920. That will be shown in the balance sheet liability side, and we will make total. So thank you children. I have given you one question. You must solve it.